Warren Buffett bought his first stock at age 11, but by the time he turned 19, he'd uncovered a set of ideas so powerful they would shape the rest of his life and eventually make him one of the richest people on Earth. It wasn't a secret formula. It wasn't a Wall Street hack. In fact, it was something most investors still ignore today. And it all started with one book. The Early Mistakes. Buffett was obsessed with money before most kids could even count it. By age 7, he was flipping newspapers and collecting bottle caps. But when it came to investing, he had no clue. At 11 years old, he bought his first stock. Not because he understood the company, but because he thought he was supposed to. Everyone was chasing stocks, watching charts, and trying to time the market. So he did the same. He memorized ticker symbols like they were baseball cards. T for AT&T, X for US Steel. He could rattle them off with ease, but he didn't actually know what these companies did. He was following patterns, hoping the lines on a chart would predict the future. But they didn't. He made nothing. 0 profits. Just years of confusion. But then, everything changed. The book that changed everything. In 1949, at just 19 years old, Buffett picked up a book that would change his entire philosophy, The Intelligent Investor by Benjamin Graham. He'd never heard of Graham before, but by the time he finished reading, he knew this was different. There were only 2 chapters that really mattered, but those 2 chapters rewired the way Buffett saw the stock market forever. They weren't complex formulas or wild strategies. They were simple. So simple, Buffett said it was almost hard to believe they were that important. But they were. Principle 1. A stock is a business. The first principle seems obvious until you realize how few people follow it. A stock is not just a piece of paper or a symbol flashing across a screen. It's part ownership in a real business. That single mindset shift changed everything for Buffett. Instead of asking, "Will this stock go up?" he started asking, "What is this business worth?" He stopped caring about charts and prices. Instead, he focused on understanding the business. What does it do? Who runs it? What are its competitors like? How much cash does it generate? What's its long-term potential? If you wouldn't buy the whole business in real life, why would you buy a piece of it in the market? But understanding the business was just the beginning. Principle 2. Meet Mr. Market. Graham introduced Buffett to a character he'd never forget. Mr. Market. Imagine you have a business partner who knocks on your door every day and tells you what he thinks your company is worth. One day he's excited and offers you double the value. Next, he's depressed and wants to sell you his shares for dirt cheap. This is the stock market. And Mr. Market is completely irrational. He's moody, unpredictable, sometimes manic. But here's the trick. You don't have to listen to him. You don't have to trade just because he's shouting prices. Buffett learned to ignore Mr. Market unless the offer was too good to refuse. That meant he could sit back for months, or even years, until an opportunity screamed at him. But even when you find a deal, you still need a safety net. Principle 3. Margin of safety. Imagine you're driving a truck that weighs 9,800 pounds, and you see a bridge marked 10,000 pound limit. Do you risk it? Or do you find another bridge? Buffett learned. Never push the limits. Always leave a buffer. That's the margin of safety. It means you don't buy a stock because it might be worth more. You buy it when you're convinced it's worth way more than the price today. That gap, the margin, is your protection. It's how you survive when the unexpected happens. And in investing, the unexpected always happens. With these 3 principles, business thinking, Mr. Market, and margin of safety, Buffett had a foundation. But now he needed a strategy. The moat that makes a business. Unstoppable, Buffett realized, not all businesses are created equal. Some have temporary success, others have something stronger, an enduring competitive advantage, what he called a moat. A moat could be anything: patents, strong branding, exclusive distribution, or just being the default choice in people's minds. Take Coca-Cola. 6 billion people know the brand. Most of them associate it with happiness, fun, and good memories. Coke doesn't just sell soda, it sells feeling. RC Cola could spend $1 billion on ads and still be ignored. Why? Because it has no moat. Buffett looked for companies where competitors couldn't just waltz in and steal the throne, but even great businesses need the right people in charge. The idiot test. Buffett had a rule: buy businesses so good an idiot could run them, because eventually one will. That wasn't an insult. It was a safety measure. Great businesses should survive leadership changes. They shouldn't depend on one genius at the top. Still, Buffett preferred honest, capable managers. But he didn't want to rely on them. The business itself had to be bulletproof. That's why he loved simplicity. Boring businesses that made consistent money. No hype, just solid fundamentals. So how do you actually find investments like that? Buffett had a secret technique. Don't forget to like and subscribe for more daily content. The reverse search method. Most people try to find the best stocks. Buffett did the opposite. He started by eliminating the worst ones. He scanned the market and quickly crossed off anything that didn't meet his standards. If a company was too unpredictable, too competitive, or too hard to understand, it was out. The goal wasn't to find hundreds of good options. It was to narrow it down to a few great ones. And he used this same method when he was a kid betting on horses. He'd study the form, estimate each horse's chance of winning, before looking at the odds. Then he'd only bet when the value lined up. This discipline led to one of Buffett's most legendary investing principles. The 20 punch card Buffett once told students. Imagine if you had a punch card with only 20 slots for your entire life. Every time you make an investment, one punch is gone. No do-overs. If that were true, would you still chase every hot stock? Would you buy because someone on Reddit said so? Or would you slow down, think deeper, and only act when you were absolutely sure? Buffett says this mindset forces discipline. It makes you stop gambling and start thinking like a business owner. He didn't need to invest every day. He just needed to make a few big bets in his life. And when he did, they paid off for decades. Buffett still wins. So how did Buffett become the greatest investor of all time? He ignored the hype. He focused on value. He waited patiently. He treated stocks like businesses, used the market to his advantage, demanded a margin of safety, looked for wide moats, and acted like he only had 20 bets to make. He didn't try to predict the market. He just understood what it's really for. And that's why he still wins. So the next time the market starts swinging and everyone's panicking, ask yourself, what would Warren Buffett do? Chances are, he'd do nothing. And that might be the smartest move you'll ever make.